Good morning, everyone. Welcome to the webinar from the AASB related to the staff FAQs addressing cooperative and mutual enterprises. My name is Clark Anstis, Technical Principal with the AASB staff, and I shall be working with you today on this webinar. Today we will address a number of topics related to cooperatives and mutuals. But first I'd like to give a short rundown on one of our most significant projects of the AASB for some time. This relates to the revised conceptual framework issued last year by the AASB and the work of the AASB to put that in place in Australia. A subtopic of that part will address the proposals for a revised definition of not-for-profit entities. Of course, we'll address the staff FAQs, including a little bit more detail on income of not-for-profit entities, which was subject to a standard issued late in 2016. And finally, a short piece on concessionary leases. There has been an amendment to the fair value requirements for certain leases. That amendment issued late in December. The board's proposals on the revised conceptual framework have been issued in Invitation to Comment 39, which has a very long title, you can see, Applying the Revised Framework, Solving the Reporting Entity and Special Purpose Financial Statement Problems. This was open for comment in two phases, and the board has recently considered the submissions received on phase 2. So phase 1 is well underway. The proposals in phase 1 are to make the new conceptual framework applicable to for-profit private sector entities that have public accountability, and also for for-profit entities, including those in the public sector, that elect to apply the new framework. Entities may choose to apply the new framework to retain compliance with current IFRS standards, including the conceptual framework. Note that public accountability is as defined in the standards in AASB 1053. The present definition refers to entities that have debt or equity instruments that are traded on a public market or otherwise hold assets in a fiduciary capacity for a broad group of outsiders as a primary business. And the definition includes some examples there. The board has a sub-project related to this definition of public accountability. The question for the board is whether to extend or change the list of types of entities set out in AASB 1053, that is, entities that are deemed to have public accountability and therefore deemed to be required to prepare general purpose financial statements Tier 1, that is, compliance with the full recognition and measurement requirements as well as all of the disclosure requirements. Now that work on public accountability is on hold just at the moment. This is because the AASB has announced that it will be considering in the next month or two its definition of public accountability, from which ours is drawn. And so it therefore makes sense for the AASB to await the next discussions of the AASB before addressing further public accountability in our standards. So to implement phase 1, we have now produced for comment until late March what we call a fatal flaw review draft of the consequential amendments to standards. So these are amendments that are necessary to support the references to the revised conceptual framework for only a subgroup of entities that are applying the accounting standards. If the comments received on that fatal flaw review draft do not identify any significant problems, then we would anticipate that the board would issue the revised conceptual framework and the amending standard with those consequential amendments by the middle of the year. The invitation to comment in phase 2 proposed the application of the revised conceptual framework to all other entities besides those already addressed in phase 1. However, with discussions with many parties, preparers of financial statements, users, regulators, extensive discussions by the board and staff, the focus of phase 2 has now been shifted to for-profit private sector entities only. So that would leave not-for-profit entities to be addressed through separate projects. For example, the not-for-profit private sector would be addressed in conjunction with the ACNC, consumer affairs regulators in the various states and territories. And public sector entities, not-for-profit entities, are subject, of course, to direction by departments of Treasury or Finance in the jurisdictions, and so the board's work on public sector entities would be addressed in conjunction with those regulators. So for the moment, application just to for-profit private sector entities. At its meeting last week, the board made further decisions in respect of that application to for-profit private sector entities. The initial application under phase 2 would be to such entities that have a statutory requirement to prepare financial statements that comply with standards. So applying the revised conceptual framework would mean that such entities would no longer be able to self-assess whether they are or are not a reporting entity, and therefore would no longer be able to decide to prepare special purpose financial statements. Therefore, such entities would be required to prepare general purpose financial statements. The board discussed Tier 2 requirements and decided that there should only be one form of Tier 2 requirements, and that is, as it is today, full recognition and measurement requirements to be applied, but a reduced disclosure set. Now, whether that remains to be the present RDR, reduced disclosure requirement set, or perhaps a set of disclosures based on the AASB's IFRS for SMEs, that remains to be determined, and the board will issue an exposure draft related to IFRS for SME disclosures. Another issue for the board to consider is whether to provide transition relief for entities that therefore would be required to move from special purpose financial statements to general purpose financial statements. Now, that transition relief could consist of a simplified approach to consolidating subsidiaries, which would be useful where consolidations have not been prepared in the past. That simplification could extend to the equity method of accounting if that were relevant. There could be simplification to obviate changes to comparative figures. So there's a number of things for the board to consider and to consult on. The board also pondered the position of for-profit private sector entities that have a non-statutory requirement to prepare financial statements that comply with standards. And a typical example here are trusts that have a trust deed that says the trust must prepare financial statements that comply with Australian accounting standards. Now, many of these trusts are not preparing financial statements that do comply with all of the accounting standards, and to require all of them to prepare general purpose financial statements because their trust deed says prepare in accordance with standards could be a significant impost. The board therefore wants to research whether some form of grandfathering for such entities might be appropriate. The board has not made any decisions on that score yet. Remains to be seen what the proposals might be. As many cooperatives and mutuals are not-for-profit entities, it's relevant just to note that there's a whole range of possibilities still on the table for requirements for not-for-profit entities preparing general purpose financial statements. Tier 1, of course, full recognition and measurement disclosure. Tier 2, reduced disclosure in some way. The reference there to specified disclosure requirements is to proposals, or at least options raised in ITC 39, that instead of saying start from a top-down approach and what disclosures should we leave out, specified disclosure requirements start from the bottom up and say, well, what disclosure requirements should we have? Tier 3 could modify the recognition and measurement requirements as well as disclosures, and that could be accompanied by requirements for service performance reporting, cash flow information, budget versus actual reporting. And finally, Tier 4, cash-based reporting. So the board hasn't made any decisions as to application of these tiers to not-for-profit entities. That will be subject to extensive further consultation. Why potentially 4 tiers for not-for-profit entities? Well, we find that not-for-profit entities report publicly down to a much lower level of activity or value of the balance sheet. So whereas for-profit entities are generally larger entities reporting publicly, for not-for-profits you can have quite small entities being required by regulators to report in accordance with standards. So therefore it's appropriate for the board to consider a fuller range of tiers for not-for-profit entity reporting. The board at its meeting on Tuesday last week decided to issue an exposure draft to propose a substantive definition of not-for-profit entities. The current definition is a rather negative one, an entity whose principal objective is not the generation of profit. We have in the past considered amending this definition to a substantive definition, but the proposals at different times have not borne fruit. So this exposure draft will be based on the New Zealand definition of public benefit entities, as they call them there, which itself is undergoing some exposure process for change at the moment. So the proposed definition is based on the definition proposed in the New Zealand process, an entity whose primary objective is to provide goods or services for community or social benefit, and where any equity has been provided with a view to supporting that primary objective rather than for a financial return to equity holders. So as you can see, that's a much more detailed definition, and it would therefore require some consideration for an entity as to whether it continued to satisfy that definition or indeed became an entity that satisfied that definition as a result of a change. That exposure draft has not yet been issued, but it should be issued in the next couple of months. What does that mean then for cooperatives and mutuals? Well, as a general description, co-ops and mutuals seek to provide goods and services in a commercial manner to the benefit of their members and or the community in general. Typically the one member, one vote equitable governance framework limited capital input from non-member investors. Now, the and/or in that first point is fairly significant. If the CME provides goods and services for the community in general, then that would seem clearly to be a not-for-profit entity. If it sought to provide goods and services to the benefit of their members and the community in general, well, there might be a question whether that's a for-profit entity in terms of servicing the members and in doing so providing benefit to the community in general. So the question, are co-ops and mutuals for-profit or not-for-profit entities? Well, of course, CMEs can be either. But the question, I think, will be, would the new definition, or at least the definition proposed in the ED, change the classification for some entities? And on that question, the AASB would clearly like to receive comments from the CME sector in response to the exposure draft. That's a very quick overview of the work on the conceptual framework and financial reporting framework projects of the board. Not much detailing what I've said about not-for-profit entities, both private sector and public sector. There is further information on the AASB's website under Hot Topics. Let's move on then to the staff FAQs in relation to co-ops and mutual entities. I would like to acknowledge from the outset that these have been prepared by Tony Connon on behalf of the Business Council of Cooperatives and Mutuals. We had quite a lengthy development period, so I'm grateful for Tony's efforts continuing as we developed further versions. The staff FAQs are divided into sections. Section 1 addresses some background questions, characteristics of CMEs. There's not a long history lesson in this part, but it does say that CMEs have been around for a couple of centuries, so they clearly fill a need and also have a very significant contribution to the economy and social life in Australia. Section 2 addresses financial reporting questions, a range of topics, which is our principal focus for our webinar today. In support of the commentary on those financial reporting issues, Section 3 of the staff FAQs provides some illustrative examples. There are 2 examples drawn from actual annual reports of CMEs as to how they have identified and described their cooperative or mutual status. Now, these are examples that hopefully other entities can use. It's not a checklist, it's an illustration. A further illustrative example deals with changes in member interests. And this is an issue often for CMEs where member shares are unable to be classified as equity in accordance with the accounting standards. Now, in that case, you often will have equity that relates only to retained profits or reserves. And so the consideration received for the issue of member shares would be recognised as a liability. So the illustrative example is one way that both the member interests through member shares and also through their interest in the equity of the entity can be brought together and disclosed in one section. And finally, there is also a short bibliography with the FAQs. Section 1 of the FAQs addresses a range of aspects. What are CMEs? How are they different from other types of entities? why does it matter? I've noted already that CMEs generally benefit their members and or the community as a whole. The focus is rarely returns to external investors. And of course, there can be differences in the focus of CMEs. For example, cooperatives may be distributing or non-distributing. Distributing cooperatives have the ability to distribute profits to their members in various forms. Non-distributing co-ops don't have that ability. So the objectives of those two types of cooperatives can differ. CMEs are often established under different legislations to corporations. Some could be established under the Corporations Act, but there are other types of legislation as well that's relevant, and of course that affects the entity that is the regulator of those co-ops and mutuals. Taxation status. We know that in many cases mutual entities have special taxation rules because of case law that establishes that an entity cannot be taxed on profits that it makes from itself. And so where you have an entity that comprises the members and is trading with the members, then there are some special taxation rules related to the profits from those transactions with members. Why does it matter? Well, the different objectives of CMEs in relation to companies that have external investors means that the performance assessment based on analysis of the financial statements should differ. If an entity is seeking to provide financial returns to external investors, then the profitability of the entity and the returns actually made to investors will be very important. If, on the other hand, the objectives are to provide benefits to members and benefits to other parties in the community as well, then profit and financial results alone won't tell the whole story of the entity. And so looking at financial statements with that knowledge of the different objectives of the entities is really quite important. I've passed over a lot of material in the FAQs related to CMEs as a sector. So I suggest that you might look at that in more detail than I'm able to cover today. But let's move on to the principal focus, which is the financial reporting FAQs in section 2 of the FAQ document. So under this heading, I think we can identify that CMEs are subject to legislative requirements on their reporting, and the FAQs also address the applicability of the accounting standards under various aspects. The reporting entity question: are there accounting standards specific to CMEs? What about for-profit and not-for-profit entities? What might be most relevant? So let's address these questions. For CMEs that are established under the Corporations Act, the Corporations Act distinguishes reporting obligations based on the size of various types of entities. So the proprietary companies large and small distinction is set out in the Corporations Act. 25 million revenue, 12.5 million assets, at least 50 employees. Now, Treasury at the moment has proposals on foot to double those size thresholds. So those thresholds haven't changed for, I think, at least 10 years. So it is appropriate to reconsider those size thresholds. Companies limited by guarantee also have distinction with fewer requirements for small companies limited by guarantee. Also of significance to CMEs at the moment is that legislation has been raised in Parliament just in the last couple of weeks to make amendments to the Corporations Act. And one of the proposed amendments is to insert a definition of mutual entity into the Corporations Act. Now, I haven't seen the detail of that legislation myself. I apologise, but it will certainly be of interest to see the proposals, and we think there would be sufficient support in the Parliament in both houses to pass the legislation. Cooperatives are subject in large part to what is now called the Co-Operative National Law. This is, let me describe it as cooperative legislation through the states and territories, so they have the same requirements, except in Queensland and Western Australia, where they still have their own legislation, which in part at least is consistent with the Co-Operative National Law. So again, under the CNL, reporting obligations for cooperatives are distinguished by size. In addition to those, you also have a range of state and territory legislation that could be relevant to cooperatives or mutual entities. For example, the legislation related to incorporated associations could well be relevant. That legislation is controlled on a state basis, state or territory basis, but we do deal with the state and territory regulators in considering the reporting requirements under that legislation. Question 10 in the staff FAQs. This asks the question, are there any accounting standards, excuse me, are there any accounting standards that are specific to CMEs? Sorry, that's question 11. Question 10, I beg your pardon. This asks whether CMEs are subject to accounting standards in the first place. And the FAQs document addresses the question of the reporting entity concept. So at present, entities are permitted to self-assess their reporting entity status. And if they assess themselves to be a non-reporting entity, then they can prepare special purpose financial statements. There are no explicit requirements in the accounting standards themselves for compliance of those special purpose financial statements with any of the accounting standards. ASIC has issued many years ago a guidance release that specified a number of standards that should be complied with by special purpose financial statements, and also the statement that all recognition and measurement requirements of special purpose financial of standards should be satisfied in special purpose financial statements. That's a regulatory guideline, and so it's not enforceable, and research that the AASB has commissioned indicates that the quality of special purpose financial statements varies considerably. In many cases, it is difficult to identify whether the recognition and measurement requirements of the standards have been satisfied. And the research that we have undertaken and discussions with various groups, users, indicate that users of financial statements want comparable, consistent, transparent financial statements. That has led the board to decide that the reporting entity concept should no longer be applied. And the proposals in relation to for-profit private sector entities are certainly putting that into place through that financial reporting framework project. So the AASB will therefore propose that for-profit entities that are required by legislation to comply with standards should be required to provide general purpose financial statements that satisfy the Tier 1 or the Tier 2 requirements. And as I said earlier, the Tier 2 requirements are under redevelopment as well, so there could well be change from the RTR requirements. But still compliance with the recognition and measurement requirements of the standards. For not-for-profit entities, those requirements will still be addressed with relevant regulators and be the subject to the full due process of the AASB, which will include exposure drafts and the opportunity for people to comment to the board with their opinions and views. Here we are, question 11. This is the one that asks the question, are there accounting standards that are specific to cooperatives and mutual entities? And the answer is largely no. The accounting standards apply generally, but there is one exception, and that is interpretation 2. So this is a AASB equivalent to an international IFRIC interpretation that addresses some particular issues in classifying member shares in co-ops and similar instruments. An issue addressed in interpretation 2 is the effect, for example, of liquidity constraints. So if a cooperative has members coming to it asking for their shares to be redeemed, and the cooperative has liquidity issues that indicates that it's unable to satisfy those requests for a period of time, perhaps until projected until after the next reporting date. Those liquidity issues themselves are not sufficient to change the classification of the members' shares in the balance sheet. Now that classification of the member shares will be subject to a standard of general application, AASB 132. But just to note also that AASB 1053, the application of Australian accounting standards, also has a statement that deems cooperatives that issue debentures to be publicly accountable entities and therefore required to prepare Tier 1 general purpose financial statements. So there are a few references to CMEs in the standards, but very limited, and apart from interpretation 12, nothing specific to CMEs. I jumped over question 12 there. Question 12 in the staff FAQs asks the question, are all CMEs not-for-profit entities? This is a relevant question because there are differences in the standards for for-profit entities versus not-for-profit entities. There are some differences in the accounting requirements and in the disclosures. Hence the question, are CMEs all not-for-profit? Now, as addressed earlier in the webinar, CMEs, of course, might be for-profit or not-for-profit. Question 13 of the FAQs asks, well, if there aren't many specific requirements for CMEs, which of the standards are the most relevant to them? And it picks out a number of standards to address under this question. The first standards identified are AASB 101, presentation of financial statements, and AASB 108 on accounting policies. So these are very significant general standards that specify how a CME or other entities develop accounting policies in the absence of specific requirements in the accounting standards, and also general requirements for presenting information in the financial statements. Given the special tax treatment of mutual entities, AASB 112 income taxes is of particular relevance. And the next three we'll deal with in a little bit more detail during this webinar. AASB 124, related party disclosures. Members have a special position in relation to a CME, and it's a question of perhaps extending the disclosures that AASB 124 might require. AASB 132, the financial instruments presentation standard. This is the standard that determines how members' interests in CME should be classified either as a liability or as equity. And for those CMEs that are not-for-profit entities, AASB 1058, income of not-for-profit entities, is relevant. It really sits alongside the general revenue standard, AASB 15, with some particular principles for how not-for-profits should account for income in other circumstances. The related party disclosure standard defines related party. It's quite a list of persons and entities that would be covered. In relation to persons, related parties are those that control or significantly influence the entity and members of the key management personnel of the entity. So that part of the definition does not include members as a general group. So if you have member suppliers to a cooperative, they're not related parties of the entity merely because they're providing produce to the entity. However, the significant relationship between the members and the entity does mean that consideration could be given in preparing the financial statements to providing additional disclosure of transactions with members. Now, this additional disclosure, for example, could address purchase or sale transactions between the members and the entity, whether in terms of value or volume or both. This would give an indication of the extent to which the entity is dealing with members, which could well be the objective, one of the objectives of the entity, and the extent to which it's dealing with other parties. Liability transactions, whether loans and member shares, if that's their classification, again, additional disclosures could be useful. The same also with equity transactions, member shares, if classified as equity, retained profits and reserves. So additional disclosures beyond those explicitly required by AASB 124 could well be justified. AASB 132 is addressed in question 14 of the FAQs. This slide gives a bit of sort of the background to this. An equity instrument indicates a residual interest in the net assets of an entity, whereas a liability is a financial liability is an obligation to deliver cash or another financial asset to another entity or person. And as a general statement, member shares of a cooperative or mutual that are redeemable at the member's option satisfies the definition of a financial liability. Now, the AASB did add an exception to the liabilities definition some years ago. This exception means that there may be instruments such as member shares which by definition are liabilities, but as an exception can be classified and presented in the financial statements as equity instruments. These two main exceptions are set out in AASB 132, the exception for portable instruments in paragraphs 16A and B, and a second exception for instruments that provide a pro rata share of net assets to another party on liquidation, 16C and D. There's also application guidance in AASB 132 supporting those exceptions, and the requirements for application of either of those exceptions are quite detailed and need to be read quite carefully. But just to say that CME shares typically fail these exceptions, and particularly the portable instruments exception, on the grounds that they are redeemable for a nominal amount, whether $2 or $10, whatever it might be, rather than reflecting the profit loss, the change in net assets over the life of the instrument. So there's a number of conditions for that exception to apply, and CME shares typically fail at least one of those exceptions. The AASB does have a current project related to financial instruments with characteristics of equity. You might hear people talking about the FICE project. Now, this project seeks to improve the principles underlying IAS 32, the international standard, but the current proposals would not affect CME share classification. The AASB received a lot of pushback on its proposal, so it's not clear how the AASB might further develop that FICE project. The proposed amendments to the Corporations Act before the Federal Parliament at present would introduce the notion of a mutual capital instrument. The question there would be whether that such instruments would be liability or equity under AASB 132. That's a question open at the moment. Now, to assist entities that have share capital that is not equity, as defined in the standards, AASB 132 has a number of illustrative examples, examples 7 and 8. The illustrative examples are published with AASB 132, so I recommend that you have a look at those examples if you are concerned about having to classify member shares as liabilities and would like to consider other ways in which disclosures about member interests might be made. And the illustrated statement of changes in member interests in the FAQs in section 3, Appendix A, also gives another approach to providing a combined disclosure of member interests as both shares classified as liabilities and any equity components as well. So we hope that that would be useful to entities wishing to provide an aggregated disclosure about member interests. AASB 1058, the Income and Not-for-Profit Entity Standard. This will apply to 2019-20, the financial year, unless voluntarily applied earlier. Now, this standard replaces much of AASB 1004, the contribution standard. We have heard over a very long time that many issues were raised in respect of AASB 1004. Many people thought that that standard produced income recognition in advance of when the income ought to be recognised. In other words, that it did not reflect the substance of transactions. AASB 1004 is also based on the reciprocal, non-reciprocal distinction for transactions, which we have heard is quite difficult to apply in practice at times. And then with the development at issue of AASB 15, the new standard revenue from contracts with customers, there was a question, well, how should that standard, which is based on a performance obligation approach, work alongside AASB 1004 that is based on reciprocal and non-reciprocal. So with those issues in mind, the board has, after a long process, issued AASB 1058. There is still some content left in AASB 1004, which does apply to public sector entities. Income of not-for-profit entities is now addressed through AASB 1058, incorporating new income recognition principles. And that includes what is effectively an exception for the accounting for what are called capital grants, where grants are received for the entity to develop an asset for use in its operations, and that asset is not being provided to other parties. So again, in this case, there's not a performance obligation to provide the constructed asset to other parties. So AASB 1058 deals with particular circumstances that fall outside the scope of AASB 15. But at the same time as developing 1058, the board also developed amendments to AASB 15 and to AASB 9, the financial instrument standard, to provide some not-for-profit specific guidance. And those were in the amending standards 2016-7 and 8. How does 1058 work then? 1058 addresses transactions which are for a consideration significantly less than fair value, principally to enable the not-for-profit entity to further its objectives. So in other words, the entity is acquiring an asset and the consideration it pays for that asset is significantly less than fair value, principally to further its objectives. So in this case, AASB 1058 says that the asset should be recognised and measured in accordance with other standards. For example, the leasing standard, addressing leases, the property, plant and equipment standard, AASB 116. So that gives you the debit, the asset. Then you also have to recognise and measure related amounts as per the relevant standards. So these could be, so these are all the credits, if you like, contributions by owners, an equity contribution, revenue or contract liability, lease liability, financial liability or provision. So identify the credits and recognise them in accordance with other standards. So at this point, the debits are unlikely to equal the credits. So then there's the question, is the transaction one to provide a transfer to acquire or construct a non-financial asset? So this is the capital grant case. So if it is a special capital grant case, then 1058 says don't recognise income immediately, the difference between your debits and credits, but instead recognise income as or when the obligation to acquire or construct that non-financial asset is satisfied. If it's not a capital grant case, then the difference between the debits and credits, according to other standards, is recognised in income. In some cases, it could potentially be a debit, an expense, but in most cases would be a further credit, which would be income. AASB 1058 includes a significant range of examples, which hopefully will assist entities in applying the standard. The amendments to AASB 15 also add both commentary and illustrative examples to AASB 15. For example, if you're considering how to account for donations received from members of the public, then there are examples there which identify whether there is assist you to consider the question whether there is a performance obligation in that transaction which would require recognition of a liability by the entity receiving that donation, and any excess consideration received over that obligation would be income. So there are quite a range of useful examples in AASB 1058 and the not-for-profit guidance accompanying AASB 15. The board has recently made an amendment to the requirements for recognising leases, an amendment to AASB 16. AASB 16, of course, changed the accounting model for lessees. Instead of having an operating and finance lease distinction, where finance leases were recognised on balance sheet and operating leases were simply expensed as payments were made or in accordance with the benefit received. So the operating and finance lease distinction has gone, and all leases are recognised on balance sheet by the lessee. This is also, like 1058, applicable from 1 January 2019, so generally the 2019-20 financial year. So under the general model, on initial recognition of a lease by a lessee, the lease asset would equal the lease liability. However, AASB 1058 made a modification to AASB 16. So in a case where a not-for-profit lessee has lease terms that are significantly less than fair value, principally to enable the entity to further its objectives, then AASB 1058 modified AASB 16 to require the right of use asset to be recognised at fair value. And of course, the lease liability under AASB 16 would still reflect the significantly less than fair value terms agreed to be paid. So the lease asset in most cases would be significantly larger than the lease liability on initial recognition. In that case, the difference would be recognised in accordance with AASB 1058. For example, it could potentially be a contribution by owners and recognised as equity. There could perhaps be a performance obligation mixed in with the arrangement, which would represent a liability, or otherwise the difference typically would be recognised as income. Now, the board has received representations that fair valuing a right of use asset, particularly in a not-for-profit context, is quite difficult. And some entities were saying that in their view the cost of preparing a fair value for right-of-use assets in their view exceeded the benefits of that accounting. So the board listened to those comments, issued an exposure draft late in 2018, and then as a Christmas present 2021 issued AASB 2018-8 on the 24th of December. This amending standard provides a temporary option for not-for-profit lessees to elect to measure a class or classes of right-of-use assets arising under these concessionary leases, either at cost, that is the normal approach under the leasing standard, where the lease asset would essentially equal the lease liability, or indeed to measure them at fair value in any case. The board considers that the fair value information is quite important and useful, and so if the cost option is chosen for a class or classes of right-of-use assets, then additional disclosures will be required. Now, the disclosures under the cost option are required to be sufficient to inform users of the financial statements as to the rights and obligations of the entity under those leases. The paragraphs added to AASB 16 do identify a number of specific disclosure requirements. Firstly, to make disclosures about the dependence of the entity on such concessionary leases measured at the cost option. If these leases are very important to an entity continuing to operate in the manner it intends, then that's very useful information to financial statement users to know that these leases are so important to the entity. The remaining disclosures identified on the slide are really some particular disclosures about the nature and terms of the concessionary leases, information about the lease payments, term of the lease, description of the underlying assets, restrictions on the underlying assets. Now, the paragraphs added to AASB 16 here also include some comments about materiality and require those disclosures for concessionary leases that are individually material, as well as disclosures aggregated for other concessionary leases. So there's not a requirement that the details are provided for each and every lease, and so professional judgment will be required to determine what would be appropriate for the specific leases of an entity. So that option to use either fair value or cost at initial recognition of those concessionary leases for the right of use assets is considered by the board to be a temporary option. The board has decided that it will reassess that option when it has further developed the guidance to assist not-for-profit entities in fair valuing right of use assets. So the board realises that guidance in relation to how to fair value could well be useful, but also the board wants to have further developed the financial reporting requirements for private sector not-for-profit entities. With that work, the board considers that it will be in a better position to assess whether to retain or otherwise modify the option at present to use cost or fair value for those right of use assets. That concludes my presentation today. Thank you very much for your attention, and I commend to you the staff FAQs. I'm sure that we will provide an updated version once some developments that are relevant are underway. For example, the changes to the Corporations Act should result in changes to the staff FAQs, and of course also the developments with the definition of not-for-profit entities and the Financial Reporting Framework project. Once again, thank you very much for your attention. Good morning to you.